My name is Jackson. I'm a host and journalist at Cointelegraph. And today we've got Seth Gins, who is head of liquid investments and managing partner at CoinFund. And we have David Greider, who is the lead digital strategist at Fundstrat. Thank you for bearing with us, fellas. How are you doing today?
Good.
Yeah, I'm great. Thanks for having me.
Awesome. So just a few housekeeping things, before we get into the show. Last week, we had a contest to win $100 of Cointelegraph merch. And the contest was to guess what the price will be at 2 p.m. Eastern time today. So we'll be announcing the winner to that about halfway through the show when we get there. And today we have a new contest, and that is for who can ask the best question to our guests. So guys in the chat, make sure you're typing out those questions throughout the whole course of the show, and we'll be picking those up and asking them to the guests. And then at the end, we'll pick which one we thought was, the best, most thought-provoking, and that person will win $100 of Cointelegraph merch. So they could get like a nice Cointelegraph hoodie, or maybe some socks. We got some Bitcoin socks here. This is a very desirable commodity. Everyone wants those. They're actually pretty comfy. I wear them more than I like to admit. So so make sure you're writing down those questions, and at the end we'll pick them. So let's get into the discussion now. Seth, I know that you are a angel investor. You were an angel investor of Coinbase, still are. And Seth, and David, you're at Fundstrat. You're a leading digital strategist. So I'm really excited to hear more from an investing standpoint, how you guys got into crypto and what keeps you excited about it. Usually we have traders on, but I'm really excited to talk to you about your investing standpoint. So let's start with you, David. How did you get involved in crypto, and what keeps you excited?
I think that's probably like one of the best questions. That's, a good way to start for people in the industry. Because I remember, back when I first heard about it, it's a story that kind of brings everyone together. It's almost from earlier days, because you were such a strange group if you were into crypto quite a while back, and you found someone like you, and it's like, wow. I think for me it's somewhat typical in the sense that I first heard about it, like most folks, during one of the bull runs. I first heard about it in the 2013-14 bull run. One of my best friends from college was mining in his dorms at the time, and he was into it there, and I saw this miner, like, what's going on here? But I, to some degree, I dismissed it for a little bit, and I didn't start taking a look at it again back until 2015 when I was thinking I was like penny stocks. I was working at Equity Capital Markets at this time, but and I was like a VP doing there in the equity side, and I'm like, it's like penny stocks, but I was listening to Chamath Palihapitiya for. As a VC investor, he's the founder of Social Capital, and I'm sure many folks know who he is from being CEO of Facebook. And he's back then, he's like, look, Bitcoin, like, this is the thing. And I'm like, okay, like, this guy's smart. This guy's very smart. I respect him a lot. So I didn't jump in right then. This is 2015. I spent about 6 months to a year of diligence, kind of taking some of the classes and figuring it out. And then finally got in around 400 and 600 in Bitcoin, and ETH, 10, 12 after the Dow hack, and that was my, first, full entry in the space. And then it's kind of been, head down focus on crypto and blockchain and, digital asset investing and tech since then. So.
Yeah, that's a very grounds up kind of approach through it, which is really cool. Seth, I'm curious to hear, how did you come into it?
Yeah, so I actually read an article on Bitcoin. A lot of people talk about the Wired article in 2011. There was a New Yorker article as well in 2011. So I read that, and I tried to buy some on Mt. Gox, and I was like, this looks too shady. So I ended up not buying it. But then as part of my angel investing in 2012, I came across Coinbase, invested in the seed round, and then from there just started to follow what was happening in the space. So until the end of last year, for 18 years, I was in traditional finance. As an equities investor. And so this was kind of nights and weekends for me. I would go out to developer conferences. So I've gone to a bunch of dev cons. I was out at Berlin Blockchain Week, and really just like, and obviously a ton going on in New York as well. And would just like learn as much as I could, read as much as I could, always with the view that like, at some point, like what I was seeing was real. It was exciting. It was early. And I always had the view that at some point, if it gets built out enough, if it's real enough, if there's enough like broader interest to make a career out of this, I wanted to come full time. And the beginning of this year was the time to do that.
Great. That's a really good step forward. And crypto is a really exciting space, especially in large part due to the price volatility, especially Bitcoin. And I'm looking at the price right now, and we're at about $9,400. For everyone who's watching, you can check the ticker right here. We got a little ticker on the screen, and you can follow the Bitcoin price real time over the course of the show. But this is a market show. We're here for the market. So I'd like to, get your guys' read on what's happening right now in the Bitcoin market. Obviously, Bitcoin's gone up quite a bit today, but, in broad strokes, David, do you want to take us off?
Yeah, sure. I mean, I don't come at it from a trader point of view, as you kind of mentioned to the audience. The way I think about it is from a portfolio strategy point of view, long-term investment allocation, and how do you manage that in the weightings, and how do you think about, proper allocations? And obviously there's ways to add alpha by being, strategic and tactical on top of that. Generally speaking, I believe that we're in the second or third innings of a bull market. And I've consistently said this, that we've bottomed. I put out a note, I think it was December or February of 2019, right? That we bottomed around then, right? And that was, the 3,000 mark. And I believe that that's still to be true, even though we had that pullback in March. I said, look, we're not going out below that. We've still bottomed. I put out another strong note back then to Fundstrat clients and said, look, this is the time after that March Black Tuesday or whatever people are calling it, that we need to be in this. And we've had, obviously, along with equity markets, along with a lot of our asset prices, we've had a rebound since. And I think that that's natural, especially given kind of the state of the crypto economy, that, being part of the digital economy, which has also performed really well within this time, cloud stocks, Amazon, all of these things, that we've seen strength there. I expect that we're still in a bull market. I certainly expect that we'll continue to see volatility. I'm never one to try to FOMO or buy, really run up into the into the price run ups. I'd rather buy on the dips and accumulate, as cheaply as possible, obviously. But I'm not a net seller here, and I'm not bearish by any means. So.
Mm-hmm. So it seems like you're holding more of a long position then.
Yes, sir.
Seth, what's your read on things?
Yeah, so just to give you a little context, I mean, I'm a long-term investor. Obviously, like for crypto, long-term is a little shorter in investment horizon than for equities. But I do fundamental research, just like I did on the equities side. Risk management is a core part of what I feel like I bring to this space from kind of the equities world. And I try to underwrite investments on a 9 to 12 month time horizon. But the risk management part is like a big component of that. So, with volatility like it has been over the last few weeks and months, you trigger those risk levels. You get to points where you have to re-underwrite. And there have been a lot of really interesting things happening in the background, which have kind of led me to move much more into a Bitcoin concentration right now. Kind of a view that we're seeing a big bid right now tied to macro. We're seeing a lot of new money come into the space. That comes in as Bitcoin first. I mean, taking a step back, it probably comes in as futures, and then it moves to spot, because we're actually like hearing a lot that that institutions are set up to buy futures right away, whereas to buy spot to invest with funds, it's going to take them a little while to do the full diligence process. So with that being the case, I mean, we saw kind of a nice uptick in Bitcoin dominance at the beginning of the month. My guess would be that that we'll continue to see. We've had a little reversal recently. I think we're going to continue to see that dominance tick up over the next few months. But like I approach markets non-dogmatically, right? I say, like, let the market tell me what's happening. There was a lot of uncertainty going into the halvening. I could have argued either way, that dominance was going to go up or that alts were going to be high beta to Bitcoin. And I kind of positioned in a way that reflected that uncertainty. So I'd say right now, the things that I'm watching most closely, so big Bitcoin position, and the things that I'm watching closely, there was obviously a minor capitulation. We had a spike in hash rate going into the halvening. That was probably a bunch of S9s coming on, trying to like squeeze the last juice out of them. Now you've had a little bit of capitulation. I've been of the view that miners are sitting here now saying, hey, we got down 6 on difficulty for the last epoch. Let's try to lock in a really big down difficulty move right now. But the problem is you have a bunch of new equipment. You have S19s coming in, and those are all like 10x the hash rate. So I think we're in a situation where price is going to be correlated with hash rate. So I think if we see hash rate tick up nicely, we're going to see Bitcoin break out really nicely. And I think there's kind of this game of chicken where for a little while, like people were comfortable sitting on their new equipment, not putting on new hash rate. But the moment that it really starts to tick up aggressively, I think it just becomes a self-reinforcing loop. And we spike up pretty aggressively because of the added hash of the new equipment. And I'd say that might be starting to happen just in the last 24 to 48 hours with the decent sized move up in hash rate that we've seen.
Great. Thanks for that. Yeah, so I'm looking at audience questions right now, seeing if we can tie anything in here. I think we've got a question from Ed Stump, who says, do you think Bitcoin needs a big shift in our economic landscape for mass adoption, or do you believe another gateway may lead to adoption, like stable coins? So I guess he's trying to ask, is Bitcoin like the catalyst for crypto adoption, or is there going to be something else that leads to it? And maybe we can try to tie this in with the whole macro angle that we touched upon earlier. David, do you have any thoughts on this?
Yeah, I think the people talk a lot about, like, do we need digital wallets? Do we need, does central bank digital currency, to stable coins, as Libra, that get people, involved in crypto? I don't think that technical digital aspect is necessarily the part of it that, maybe to some degree the security, the custody, but I think it's people understanding kind of the investment merit and thinking about that properly. I think that one day in the next few years, people are going to look at crypto assets, things like Bitcoin, as just tech investments, as kind of a next extension of, what we've seen with the internet in kind of a different form, right? Things evolve. And I think people are going to look at it as a play on the digital economy and that growth, similar to the rise of cloud computing. I think that once people kind of shift the narrative around what the investment opportunity, represents, I think that then you can start to see, as more education happens, more traditional folks who have been, investing in tech and have been looking at crypto for a while, the skeptical, they just haven't spent the time, perhaps. I think that's what changes the narrative. I don't know. I know we had some slated to talk about some of the macroeconomic stuff. I don't know that, some huge, U.S. economy meltdown thing is going to be the catalyst or anything. But I really think it's capturing that fundamental growth story on the tech side that's really going to be kind of the catalyst as people get over. And another one will be the generational shift, right? That happens when, as new classes of, younger investors come over and they take in, or users, or like with the internet, our parents. I think that's probably, how you transition over time from my point of view.
Mm-hmm. Seth, do you have any thoughts on this?
Yeah, I mean, look, I think I was really bullish on Bitcoin going into the year, but when you get more stimulus by multiples from March to May than you got from 2007 to 2013 combined, that's a huge catalyst for crypto. In my mind, like that is a huge tailwind. And I think like we're seeing that in institutional interest. We're seeing that in like the Paul Tudor Jones letter. Rentec. So there's a lot of interest that's starting to percolate as a result of what's happening in the macro world. And I think another big component is there's been a lot of movement on central bank digital currencies. We've gone from kind of zero to kind of like 60 miles per hour in a matter of a month or two. Part of that is the progress that China's made on that front. Part of that is the stimulus checks and seeing a digital currency and having people have wallets as a really efficient way to get money out to the population that takes a lot less time than sending checks for 3 weeks. So I think there've been a lot of things going on that have been catalysts on that front, and I think that opens up the space. You put a digital wallet in a large percentage of the population's phones, and that just opens up an immense number of opportunities. And then like Libra, obviously, like people had left Libra for dead. I was of the view that Libra was not going away, that there was a lot of momentum, and now we've had a refresh on the white paper. We've had them doing the Swiss filing. So a lot of good momentum there, a lot of excitement. And then like broadly, like India, the Supreme Court decision, which invalidated the RBI ban on banking crypto businesses, like that's a really big deal in a really big country with a large population and a lot of great crypto talent and crypto interest.
Great. It's really interesting that our conversation is steering towards these central bank digital currencies. I think this ties in really well with one of the questions from our audience, actually. And I know we didn't really prepare these topics as much, but maybe you guys can have some comments for this. Tom Sen asks, how will digital currency from China and the inevitable U.S. reaction affect Bitcoin adoption, especially if a trade war escalates? Seth, I know you're just touching upon this. Do you want to take off with this one?
Yeah, I mean, I think they're going to be like a whole cascade of influences and impacts tied to that. But I think stepping back, what it does is it puts a crypto compatible wallet in the phones and computers and the daily workflow of a large part of the global population. So that's kind of the high level for me. When I think about what it does downstream from there, I think it actually like dovetails with self-sovereign identity and what can happen if you kind of take KYC, know your customer, and move that to the edge of the network, out in people's wallets. It's essentially analogous to, people talk about how 2 decades ago when we went from where if you were a startup, you had to buy hundreds of thousands of dollars of racks of servers to be able to go into business, to being able to pay $5-10K a month to a cloud service to spin up servers, and to not have like this big fixed cost burden for like a business that was like 5 times the size of where you were starting. You could actually scale it up with your business. I think like when you think about like KYC at the edge, self-sovereign identity, what like the lower friction digital currencies do to the fintech landscape, the financial landscape, it's essentially the same thing, right? It makes the cost of being a disruptor come down a lot, and it drives not just like a Cambrian explosion of like new startups and potential competitors or challengers to incumbents, but it also like materially changes the return profile of investment opportunities. So it's kind of like it's great for the companies. It's also great for the investors, and that becomes a positive feedback loop.
David, how would you like to respond to that? Yeah.
Well, I was listening to Peter Thiel from Founders Fund talk at the Economic Club of New York, and one of the really interesting things that he said that caught my attention was, for some time we've had this free flow of value, of ideas, of trade, and of people. And then he said, when you think about that from this crypto standpoint, right? You think about the free flow of the financial system. When you have money, you have the internet of information, right? And then you have people with this globalized economy. And then, he said it's almost like a dystopia, this future, which we get to decide which type of world we want to live in. And we think about, whether we want to kind of this Chinese, version that's this, kind of government, they can see everything you do, or we kind of have another version that's a crypto version where you have this free flow and these things that happen. So when I look at what's happening politically and geopolitically and technologically, between, within China and between China and the US, and I look at, the rise of things like central bank digital currency and, perhaps some of the privacy issues and some of the things that happen with that. And then I think about the splintering of the tech war we see between the US and China, right? Where, we obviously, we're getting national champions, from each country, the US and China really are the dominant economic tech powers, right? And we're seeing that play out, and we're seeing that with sanctions, right? And we're seeing a splintering across a couple of these effects, right? And I think that, what it means for, crypto technology, right, as a global decentralized governance system, right, that is capable of being a neutral platform, across these borders, right, and outside of these types of political influences. I think that it's actually, it's impactful from like a philosophical, social level that, I think, yes, absolutely. It's very great that you're going to see wallets and people get into the, using blockchain digital currency. But I think I think it's different in the sense that, it's about how we govern our societies, right? I think that it's a similar, having digital currency is kind of a similar, digitized mechanism, right? In the way that we transact in our society. But I think that the real innovation, the real key, the real driver is going to be how does crypto influence the continuation of the globalization, the interconnected societies that we've had over these years, right? As you see these kind of opposing forces kind of taking hold. And I think that it's bullish, from that standpoint, in the sense that, I think people want to be connected. People want to have interconnected economies. I think that's how it could maybe be influenced. So.
Yeah, I think that's a great way to put it. Cryptocurrency has a lot of drive behind it, not only fundamentally, but also, as you mentioned, philosophically. There's a lot of motivation for people to get involved in it. I just wanted to take another moment to remind our audience, keep asking those questions. We've had a few great ones so far. And if you have the most interesting one, you'll get that $100 of merch at the end of the show. If you're enjoying the show so far, please hit that subscribe button. It helps us, put on these shows every week. And it'll keep you up to date. Make sure you catch the next one. So, and now I'd like to move on a little bit. Let's kind of retrace our steps more towards the macro stuff. And we touched upon, tangentially some institutional involvement in the space. And if anyone's been following the news, there was recently a leaked slide from a Goldman Sachs meeting, which stated that Bitcoin isn't an asset class and advised clients against investing in Bitcoin. This stands in contrast with former presidential hopeful Mike Bloomberg, who acknowledged Bitcoin as an asset class in his presidential plan. So, guys, which side are you on? Are you on Bloomberg's side, or are you on Goldman Sachs? Seth, let's start with you.
Oh, I think it's an asset class. I think crypto broadly is an asset class. We're starting to see people allocate to it. I think like that question has been settled. One of the interesting takedowns of crypto that we've seen, we saw it yesterday, was the idea that a lot of crypto is used for illicit purposes, and I thought it was really funny. So first of all, the report mentioned I forget the exact number. It might have been 800 million being used for illicit purposes, and of course it was from Chainalysis. Well, guess what? Like, the reason why you can have a 2019 estimate of how much Bitcoin was used for illicit purposes is because it's pretty transparent. It's out there. That's the advantage of being able to have something like Chainalysis out there. If we wanted to have an academic study of how much US dollar cash was used for illicit purposes, we might have an academic study in 2023 on that, right? So I thought that was a really good indicator of kind of the how stale that type of argument is as a takedown on crypto. One thing that I want to jump in or go back on, though, is the idea that, when I think about central bank digital currencies, and this kind of dovetails with your question a little bit, I think what we're seeing is we've already, like, a lot of the primitives of both central bank digital currencies and things like Libra are coming from the open source community. And I think the open source community is still going to be vibrant. It's still going to be super important for innovation in the space. I think there's going to be a part of the rails that is tied into official currency. And then I think you're going to still have a very vibrant, active, and fertile open source community, which is not surveyed in the same way as traditional government currency. So I think we're likely to see parallel development there. And the last thing I want to jump in on Libra, and by the way, like, from a regulatory perspective, like the digital currency working group at Treasury that was in the news a few months ago, like, I think they're moving in that direction, and that's all very positive. Being open to having a vibrant, innovative, open source community. And on the Libra side, I think a big part of Libra, and something that people aren't talking about, is the idea that Libra, in my mind, is really about Facebook not having ownership of our data anymore. I think it's about creating a construct where users own their data. Users have the private keys to their data. That can be their transaction data off of Libra. That can be their text and photos and videos off of Facebook's platforms. And I think the whole idea is, you guys own it now. It gets us out of the dynamic where we have big liabilities tied to owning user data. But we'll give you a compelling reason to permission that data into our services. We'll let you monetize it rather than Facebook owning the data and monetizing it. And there's some really cool ways for Facebook to do that, for users to solve complete ownership, and for Facebook to actually generate much more revenue than they do today, because we're talking about really high value, validated transaction data, if we're talking about the financial aspects of that.
That would be quite a world to see. But actually, I'd like to, go back to the original question. David, Goldman Sachs or Bloomberg, are we in an asset class? But I mean, I'm going to go out on a limb, and I think I know what your answer will be. But why do you think Goldman Sachs is so reluctant to acknowledge Bitcoin as an asset class?
Well, I'll take a nuanced view, because I think first, just starting out, Goldman, they're obviously smart folks. They're very, very smart folks, right? They're some of the smartest folks on Wall Street. I think that the narrative that they put out, on the call and in the deck, it's very 2017, 2018, from the ICO boom and that type of narrative. I don't think that the narrative that they've kind of put out has evolved much. I think that there's two potential things, right? They haven't spent a ton of time looking at it since, and they're getting a lot of questions now, and they're trying to figure, hey, what do we say? How do we advise folks? Or two, maybe they have a good take, right? But I think it's very possible that for political reasons, right? If you're Goldman Sachs, for political reasons, you want to be cozied up to, obviously, the U.S. government. You want to, you don't want to upset the apple cart in China, right? Like, you have a lot of business at stake as it relates to, it's just for political. I could see that as a real reason why, even if you had a positive view on it, you would want to stay away. Is it an asset class? Let's just start with this first, right? Is it an investable asset, in my view? Yeah, absolutely. I think it's absolutely an investable asset, right? And I think that it's actually a series of many investable types of assets. Right. I think that people generally tend to take this bucket and they call something crypto, and they say, it's all this new thing. And I think that kind of, similar to what, Seth is saying, some of these things, it's like, I think you have a lot of different digitized crypto being different forms of governance, global digitized governance. But from an economic standpoint, I think a lot of crypto assets resemble traditional assets. Right. But within what I consider to be this emerging digital crypto economy, right? And I think about that in the sense that, you have a globalized, self-sovereign kind of governance structure that's enabled by the technology. But I think from an economic standpoint, some of these things like decentralized companies, it's effectively, some of these are decentralized equity in their economics, right? They pay cash flows, some of them pay dividends, right? One of the Goldman's points is that, you don't get that from crypto. I'll assume that they're really just talking about Bitcoin there, which is true, right? You don't get that there, but a lot of these cryptos, you do get cash flows, you do get dividends, they do have equity like governance features. I mean, if you look at Maker, I mean, it's effectively like a decentralized bank, right? In the traditional equity sense. So I look at that as it's digitized crypto equity, right? It's not, the governance structure is what's unique. The economic structure is the same asset class. I look at Bitcoin and I say, it's a monetary commodity. It's mineable. It's a commodity. I look at some of the compute power behind a lot of these other ones. It's compute commodity, right? And I look at stable coins and I almost consider them digital debt, right? With a different governance structure, a crypto governance structure, right? Which is unique, right? It's global, but I think of these as an emerging economy, an emerging market, right? I put out notes and I've called it crypto EM. Right. And I think that that's the way people need to think about it. As we see a rise in the digital economy, right, as more goods and services move online, as you have more data, you have more applications, more internet usage, you get self-sovereignty over these digital economies. People can choose which one they want to transact in. And then you're going to have assets form, you're going to have applications form that represent that, and smart contracts, legal things that give you the legal structure to do it. Right. So my thesis has been, you don't need to think about investing in crypto as investing in this next gold necessarily, right? I think that you can think about it as the next oil, right? Ethereum, for example, is the next oil for this digital economy, right? Your gas gives you the compute resources on this economy, right? And as we have a growing digital economy, just as the industrial age emerged, right? And fuel went into cars, it goes into all of the products that consumers demand. You're going to see a similar rise in these commodities, right? In these companies, in these applications, in these consumer-facing products that are investable, right? And I think that from an investability standpoint, what matters and what folks should be talking about is not whether Bitcoin has the characteristics of, too high volatility or too low, or whether it's, I think what people really need to care about is, from this standpoint, is it something you want to put your money in, and why, right? What trend are you capturing? And is it an investable asset? And I think that's what's key.
Mm-hmm. Yeah. Before I throw it back to Seth, I just have a really exciting announcement. We have the winner for last week's contest, Munish Mohalcha. I'm probably mispronouncing that, but they guessed $9,450, and the price at 2 p.m. on coin360.com was $9,459, $9 off. That's pretty good guess. So in order to claim your reward, just go to the About page of our YouTube channel and contact the email in the About section, and we'll send you the code and get you those credits. So thanks for participating. $9. That's pretty good, for calling it a week ago.
You could have our job, Seth.
Exactly.
Yeah. Prescient. So Seth, David was talking a little bit about, why Bitcoin may not be, or why Bitcoin, the volatility of Bitcoin and the risk of it as an asset. And one of the things in the Goldman Sachs slide was warning investors against the volatility and saying it was too risky of an asset to invest in. And you have, a broad risk management background. So I'm curious to hear what your thoughts on this are, as Bitcoin as, is it too risky of an investment?
Yeah, I think you need to think about risk in a few different ways. So first of all, I look at the volatility of Bitcoin, and it actually, if you look at the way that gold kind of came into its overall market cap over the last 5 decades, just with more liquid markets, it actually looks surprisingly similar if you put gold on a log scale and Bitcoin on a log scale. but look, I think part of that is how do you get from a small amount of value where Bitcoin was a decade ago to something that's relevant on an international and institutional scale if you don't have volatility. So that's kind of like the highest level look at risk and volatility. Then if you kind of go into like what happened around Black Thursday and around the COVID issues, I think what you really saw was a market that in the short run, you had a lot of people getting very bulled up around the halvening, and you saw leverage, open interest in futures markets just like go up a ton. And then COVID came out of the blue, and it wasn't really out of the blue, but from a market pricing it in perspective, it was. And you went through this like whole deleveraging cascade. And look, there aren't circuit breakers on crypto exchanges like there are on the stock exchange. We certainly hit a lot of circuit breakers on the equities exchange during that time. And that was what we saw happen in crypto around that time. What I took a lot of what I really liked to see around that move down was the fact that we bounced back quickly. Like literally within a day, we were back up at 5,000, and then it was a very orderly rebound from there, without a lot of leverage being added to the system until we got to much higher prices. I saw that as kind of being a market that went through a deleveraging dynamic. Same thing, I lived through 07 to 09. I know what like deleveraging environments feel like, right? Like we very much saw that in crypto in March, but then it was a very orderly rebuilding back, and to see leverage start to come back in, to see institutions start to come back in, to re-engage because of all the stimulus. I'll tell you what. One of the things that I really look for from a risk management perspective is I want to see that crypto, whether it's Bitcoin or other coins, are actually tracking to fundamentals. That's really important. It shows that like it's becoming a more mature market. And I can tell you a few things over the last few months that have really that have really impressed me with regard to like Bitcoin's maturity over the last year or so. One was if you watched what Bitcoin did when we had stimulus announcements from the Fed and from Congress, it responded immediately to Fed stimulus. So monetary stimulus was what like Bitcoin responded immediately to. And that kind of makes sense. Like that's the stimulus that kind of like ties into the idea of like Bitcoin as a store of value, the great monetary inflation. Now, realistically, if we're in MMT, we're going to be monetizing deficits anyway down the road. So fiscal stimulus is monetary stimulus down the road. But just thinking about it from the perspective of like, what's the direct impact for Bitcoin? It's getting more Fed stimulus and seeing a response right when we got that. I thought that was like a really good sign. And then the second thing was going into the halvening. We did a lot of work with talking to miners, trying to figure out which levels of Bitcoin were going to lead to material capitulation. And it was interesting. Going in, I kind of come to the conclusion that 8,500 to 9,000 was a really important range for Bitcoin's price, and that there was kind of like a convexity. Like imagine you're at the top of a hill, and to either side of that range, you could either accelerate up or accelerate down in price with either capitulation or people covering shorts if they think it's not going to happen. And where did Bitcoin trade? Right into the halvening. It was right in that 8,500 to 9,000 range. I always assume, like, I'm not the smartest guy in the room. If I can figure that out, other people are figuring that out too. So I thought it was like a really good sign that like clearly people are doing fundamental research. They're trying to like think about a framework for Bitcoin's price that's like tied to fundamentals. And they came up with the same range that we were coming up with. And I thought that was a really good sign. It ended up being totally irrelevant for what Bitcoin did in the 2 weeks afterwards, because we had that spike going in of hash power. And then we actually had big capitulation, even though the price was higher. but that's where like that last thing that I talked about, which was, letting the market kind of tell you like when things are changing. That's where that really comes into play. But I've really been impressed by the fundamentals, the way fundamentals have played into Bitcoin. And then when you move away from Bitcoin, there's some equity-like value capture dynamics, like what David was talking about. And you can look at like valuations, and you actually see like consistent valuation ranges for a lot of these tokens. And that again tells me that someone's like, a lot of people out there are looking at valuation. And when it gets to the low end of the range, they're buying it. When it gets to the high end of the range, they're selling it. So again, it's a sign of the maturation of the asset class, which like is just inherently a de-risking of the asset class. And then the last thing I'll say on risk management is just like, when I'm actually looking at assets, I use like the same type of re-underwriting dynamics that you see at a lot of hedge funds. But obviously, like, at a hedge fund, if you would say like, oh, if this is down to 8%, we have to re-underwrite the thesis. In crypto, 8% is like an hour. So I use much bigger percentages, but same thing. Like if I'm getting an adverse move that's 15, 20%, that's when I have to re-underwrite it. If I can't re-underwrite it, you know what? I might have the most bullish view on fundamentals over the long run for that token. I can always de-risk. I can take it down. I can get out of it. That's the great thing about liquid markets. You can risk manage. And at CoinFund, we look to avail ourselves of that risk management ability and that liquidity.
Yeah, that's a really interesting. Well, you point out a lot of interesting things, but one I'd like to touch upon was, the relationship between the fiscal stimulus and Bitcoin. And, there's especially throughout March and April, there was a lot of talk about, the debunking of the Bitcoin as a safe haven narrative. In the leak slide of Goldman Sachs, we saw them calling it not a hedge asset. Well, if people are taking their stimulus and putting it into Bitcoin, that would suggest that actually the opposite is starting to occur, which kind of ties into a couple of questions from the audience. One of them from Andy G. He's wondering, why is Bitcoin not acting as a safe harbor asset as we predicted before? And Doodle is wondering, what happens if Bitcoin moves into the post-halving explosion phase? A lot of institutions actually have predicted that Bitcoin's going to go on a bull run. And then, what if we move into this upper phase and the market just pulls another march? Is Bitcoin going to crash with it again? So I think most of these are just dealing with the Bitcoin as a safe haven narrative. Are we seeing it shift? So I'm curious to hear your thoughts on this, David. If you're seeing this shift in the narrative as well, this de-risking, as Seth called it, of Bitcoin.
Yeah, I mean, I think the markets are becoming more mature. That's certainly true. I don't actually. I think people try to put Bitcoin and crypto in this box, which is like this gold, this safe haven, this currency, this store value box. That's like gold. I think that you have people like Goldman, and they're looking at it, and I think they have some from the angle they're looking at it, from the story they're being told. I think that they're like, well, yes, the dollar is much more stable. Yes, inflation is very low. This is not the stable store value. But I think that that's the wrong way to think about it from a crypto and from a Bitcoin perspective. And I think that really, if you think about it, like yes, it's a risky asset. I mean, we see that the correlations are strongly tied to risky assets. But I think that if you think about it as this emerging digital economy, right? You have liquidity. Yes, it has the same net effects as what you would say for being inflationary for gold, right? They say in the Goldman note, they were like very heavily focused on equities rise better than gold with easing with monetary inflation, and that's right. They're absolutely right. And the dollar, I don't see anywhere else from a traditional fiat standpoint, given kind of the geopolitical structure where the dollar has a ton of weakening. I don't see the reserve currency status as a problem. But I think that the real thing that people should think about for Bitcoin and for crypto economies, from digital economies, from an investability standpoint, is again, it's not that you're investing, I don't think, from my view, in this new digital gold. I think that you're investing in this new digital economy, and you're buying real estate in this digital economy. And I look at, we had this transition, right, from if you think about the way that the world has evolved, right? We've come, we've been, the Europeans have, settled different continents. We've gone to emerging markets, right? The physical sphere is settled, right? And if we look as we're moving up the level into this global digital economy that we have, right? I think that's where you're buying your real estate. And I think that it's like saying, if you think back to the U.S. stock market in, let's just say, the 20s and the 30s, the roaring 20s and 30s, I don't think if you're Goldman Sachs, you would say necessarily that was an uninvestable asset that's not safe for your clients, right? I think you would certainly say that the stock market would not be the very safe place you want to store your wealth if you're about to retire for your clients. That is completely fair, right? But from an investability standpoint, that would be a terrible decision if you said, I'm not going to buy U.S. stocks, right? This rising strong economy in the world, right? And you're not going to own that for generations to come as you see a ton of productivity growth, as you see an economy emerge. And, it would be ironic. I think maybe if the narrative was different, right, from the crypto community to the traditional community, maybe people would think about it in a different way, right? Because, from one sense, you are seeing somewhat of a new emergence of an asset class. Goldman, from what I understand, they underwrote the first equity IPO of Sears, right? So I think that those guys, would be someone who maybe, if you could see it, maybe you get a better response from those folks, right? But I think it's on that narrative side that maybe we have kind of the wrong view, and that's my take.
Jackson, I like the whole store of value thing. Like it was certainly, Bitcoin was certainly volatile in March, but man, like it's outperforming every other asset class year to date, right? It was up 92% last year, like more than any other asset class. So the idea that it was volatile, like doesn't matter to me. Like it's about knowing what you want to own. That's where the long-term view, the long-term fundamental approach comes in. Like Bitcoin has absolutely performed well and shown that it's performing as a store of value in this crisis. It's up more than gold, up more than the S&P, up more than on treasuries year to date. Like I don't know what else one could ask for a store of value other than just constantly ticking up every day, which I don't know anything that does that, right?
Yeah. So it does seem like, and David mentioned this earlier, that this is a bull market. And David, there are a number of factors that may indicate it. One of them, is from a Cointelegraph report, which says that 60% of Bitcoin supply has not moved from its wallet in over 1 year. This could be, a sign of significant hodling. People are really taking that long position on the market. And David, you tweeted that when Bitcoin sells off and altcoins sell off less, we're in a bull market. I'm curious to hear you explain a little bit more why you see that as an indicator that we're in a bull market.
Well, yeah, I guess I'll answer that last question first, and then I'll touch on the first thing you said second. I just think that it means that when you see you think about the crypto economy, right, as the global crypto market cap, right, and if you think about beta relative to Bitcoin, right, if Bitcoin sells off 5% and these things sell off more, right, you've probably seen more value kind of leave this global crypto economy. But if you see Bitcoin sell off incrementally, and then altcoins are kind of rising, right, it's the value flows where the value is flowing within the economy. It's not necessarily that it's coming into crypto and going out. It's that it's flowing around different places, and we've seen that kind of altcoin rotation occur, 2015, 16, 17, kind of how you had these cycles. I don't think we're in anywhere near those cycles that existed before, but I just think that it's incrementally bullish. I'm not saying that we're in the heated 2017 rise because of that, right? But I certainly think that you see stronger fundamental dynamics that underpin the market, right? And to one point, Seth, like that he said, is you've seen the leverage taken out, right? And this happens, I think, in all markets, right? You've seen the leverage taken out of the market. That's healthier for it, right? You've seen a lot of debt that's been wiped out, and I think you can rebuild on healthier footing. You've seen back to the first thing you said on the 60% that haven't moved. Structurally, there's a really strong structural reason that you get the boom and bust cycles that occur in crypto because of the incentives that occur around exactly what you just described. So if you think about it from a supply demand dynamic, it's not just that you have miners and new coins as your new supply, right? You have a net supply on an asset, right, that is of the entire asset base, right, which is 85% of the Bitcoin supply now. So it's much more material existing supply relative to new supply than it's been in the past. And I think the way to think about it is from a real estate perspective, and from like almost like a land or a housing economy perspective, right? If you look at what you had in after the financial crisis in the US, for example, and you think about the way that, you had people, forced out of their homes, capitulated, whatever, very unfortunate situation, of course, right? But what happened is you had people underwater on their mortgages, right? And I think the analogy that holds here is, once the banks have repossessed, right? And once people are underwater on their mortgages, they're waiting for prices to rise again before they're going to, sell their home, move up into a new home. You have a structural supply side dynamic that limits the sellers. And when you have boom and bust cycles that have occurred with Bitcoin, you get people on, the hodl cliffs, and you've seen the hodl waves. And I think that the economics from the incentive standpoint are very, very similar, right? And what people do is, if you're going to invest in Bitcoin, you're going to invest in crypto, you're going to have a very high expected rate of return probably. And what happens is people tend to not, once the people who've been flushed out, right? You have the true believers, they tend to not sell until, you get a significant price rise, and you get these booms again, right? After you have some consolidation periods, and that logically makes sense to me from a market psychology standpoint. So I think that what you've described with the coins that haven't moved, it's natural. I think that we've seen in other places of traditional economies. I think that it's what perpetuates the market cycles that we see. I think that it keeps the market on healthier footing. And I think that that's one reason why I think we've really come through we've certainly come through, I think, the bottom of this. And, I'm not telling you we can't go back down, right? I don't think that would be an over assertion. But I think generally speaking, some people have wisely done, as you've seen opportunities, I think that you should take them, right? But of course, manage risk, right, along the way. And, again, that's why I think about it from a portfolio construct. How do you properly allocate to this, emerging economy, right, to this emerging tech asset class, right, as we've called it. And I think that, I think we're in a good position.
Yes, go on, Seth.
Jackson. So Andreessen Horowitz put out a great blog entry like a week and a half ago about crypto cycles and why they're important to the space. I really resonated with me. So, basically the idea that the bubbles that we see in the space, they bring in capital, they bring in developer talent, they really lead to the next big wave of innovation. And I think that was the case with the 2013 bubble. I remember when we came off of that, and this was when I was still in my equities role, watching the growth of GitHub repositories and the fact that there was a lot of developer activity. As a sign that this was real, even though it was down a lot from the peak, this is real. There's a lot of developer activity. And then you look at the same thing that happened after the 2017 bubble burst. Immense amount of developer activity. We have a really active venture arm at CoinFund, and we're just seeing a lot of really interesting projects. Have just made a few investments just in the past few months. So I think that the boom and bust brings a lot of capital in. It brings a lot of new talent in. The existing awesome talent stays, and the ecosystem just continues to grow and become more impactful with each cycle.
Yeah, and going off of that, there's been a lot of talk of how another cycle could bring in lots of institutional investment, and we saw Paul Tudor Jones getting involved. There's been multiple long-term predictions from Dan Moorhead from Patera Capital, Tim Draper, the Perma Bull, and how do you guys see these institutions? I mean, besides these boom and busts, how are these institutions getting involved in crypto? Do you think they're already here? And will they? There's a lot of expectation that this institutional involvement will lead to mass adoption, right? Do you expect that to be the case? David, let's start with you.
Well, no, look, I don't think they're here. I mean, it's kind of loaded, right? One, I'm going to advise all of our institutional clients, when you get the boom cycles, I'm going to tell them to avoid investing. I think that there's a very good time to invest in crypto. I don't think it's always, right? I don't think I think, as Seth mentioned, you want to buy assets at the right price. And that's very key, right? So I don't think that necessarily investing in the boom and bust cycles is the smartest move. I would advise our institutional clients, when the time is right, I think that when things are really overheated, I would not want them to be invested. Being said, I think some people have their toes dipped into the water, certainly. You see it from some family offices. We have clients who you have some hedge funds who will look at it, but I don't think in mass and in droves. I mean, obviously it's not, because if you look at the size of the market relative to the size of the investable asset base, you don't have the capacity to absorb the type of capital, and I don't think you should. I don't think, look, as an institutional investor, it's your job to make money for your clients, for your fiduciary, as a fiduciary. And I don't think, we should expect, or we should want them to jump in at a ridiculous 2017 bubble valuations, right? I think that what we want a healthy growth in the fundamentals, and we want a healthy growth in the economy. And I think that we want people to generally buy into crypto assets in these crypto economies at the right prices and right valuations as the technology grows, usage grows, right? And I expect that will happen over time, certainly. Will you potentially see another boom cycle where you have these, retail, maybe speculation? I mean, it's possible, right? We have a lot more users on board, and maybe you get traders, like Goldman has said, who want to trade that wave, right, at any price, right? I don't think you buy it as an investor at any price. I think you can trade at any price, but I certainly also don't think Goldman's right in that you shouldn't own crypto at any price either, right? I have a lot of valuation models that I look at, and one that I invented in 2017 that's been very useful for me since at the peak of the bull market was I've looked at the cumulative mining costs, right? Not the current mining costs, because you can blow through that. And this is something that's historically shown always to be a value metric, right? As like a replacement cost. And I've always seen that as you get too extended from that, over time, you have a lot of unrealized profit in the system, and then you have people tend to sell, and then you have crashes and booms and busts and crashes. And I've always made it my approach since to avoid overexposure at the edges, or at the top edges, and to make sure that you can have heavier exposure when prices are cheap, right? If I think about it, from a Graham and Dodd, or even from a growth, a GARPy, like you want to buy, growth at a reasonable price standpoint, like I want to buy into this crypto economy at the right prices as well. So I think that I think it's about like any investable asset, you want to understand the fundamentals. You want to understand the investability of it for your particular risk standpoint, and then you want to allocate reasonably based on that. And I think that'll come. So I'm positive about the future from that standpoint.
Mm-hmm. Seth, what do you think? What are your thoughts on institutional influence in the space?
I think they're here. They're
full force.
I mean, not full force by any stretch of the imagination, but they are definitely starting to come. And it's institutions, obviously family offices have been involved for a long time, but we're going all the way up to the largest sovereign wealth funds, pensions. Like you're seeing interest across the board. Now, it's taking all different forms. Some of it is getting involved on the venture side. Some of it is actually doing direct investments. A lot of it is in the futures market because that kind of fits into the current infrastructure that a lot of those asset owners already have set up. But institutions are here already. We're probably in like the top of the first inning, to use a baseball analogy of the flows. I don't see like any way, given the market cap of overall crypto, I don't see any way that we're like further along than top of the first. And my view is, Morgan Stanley had a report from the back half of last year talking about how the institutional side of crypto was 19 billion of assets under management. And I think it's probably about 30 billion now if you factor in Grayscale's growth and the activity that we've seen year to date. I think this is $1 trillion asset class, both from flows, meaning inflows, as well as from price appreciation over the next 2 or 3 years. So I think like that's how early we are. We're at 30 billion, and this is, I think, going to be a $1 trillion+ institutional asset class in the next few years. So very early, but absolutely happening.
That would be amazing to see, and I hope it happens. Yeah, so I think we're nearing time. So I just would like to set one thing straight. We have a viewer. Where is he? His name is Nabhash, and he's curious, to know if, Seth, you are the founder of Coinbase. Is that true?
No. we're both bald, but that's about the end of the similarities.
Would you mind sharing like a little bit about how you came to be an angel investor in Coinbase?
Oh, it was total luck. I was doing, there are these crowdfunding platforms. A fantastic one is called Funders Club. They've been around for a while. They went through Y Combinator, and I did a small investment in Coinbase off of Funders Club. They were all in the same Y Combinator class together, so it was like Funders Club came in and listed all of their batchmates. And at the time, I was like, look, I've read about this. I mean, I always believe luck favors the prepared mind, right? So for me, it was, hey, I had read about this a year ago. I thought it was really cool. There wasn't like a really straightforward way to participate back in 2011. So I was like, look, this is a great way to make an investment in the space. I actually invested in Coinbase before I owned Bitcoin, and then I bought Bitcoin right after that.
Hopefully through Coinbase, right, Seth?
Exactly, yeah. Of course. But it was really at the time it was a call option on a call option, right? It was like, is crypto going to be real? Like I was certainly hoping that it would be, but in 2012 it wasn't clear. And then from there it was, is Coinbase going to still be around by the time that happens, right? Because companies that burn, they have a certain amount of cash. So things like the stars aligned, and Coinbase ended up being a big winner, and I think will continue to do incredibly well. I think they're very well positioned in the space. But yeah, I wish I could say like I had this, like I saw Coinbase and I knew right away that this was going to be a gigantic company and be one of the biggest in crypto. I mean, to be totally honest, it was having knowledge of crypto and feeling like it was a really interesting bet to make.
Yeah, luck favors the prepared mind, as you say. I think that's a good one. And actually, I said that we were going to wrap this up soon, but I'd like to ask one more question from the audience, if that's all right. This is from Jesse Talamantes, who says, how do normal investors structure themselves to deal with capital gain losses the way the big boys do? I think it's a good kind of like parting question for you guys to answer. David, would you like to start?
Capital gains and loss. Seth, you got to take that first. I mean, I'll give it a go. I'm not an accountant, or I'm not implying Seth is either, but I have to think about it. I'll give you an answer. I'll give you an answer. Look, if you're going to be a big trader, look, there's a trader and there's an investor dynamic. And, I think if you want to have a structured you want to put a portfolio together, right? I mean, you could, in your IRA, you could buy in GBTC or other products, that are coming online that exist. Bitwise has been doing something as well. And you can get some tax advantage ways to do it. Speaking outside of the IRA, I I think you want to buy at the right price. You want to hold for the right time. I mean, I certainly think you want to sell if you're at the top of a big cycle. I don't think you want to. I think you better have a portfolioed approach on the crypto assets that you own, and to just set a good allocation, right, as opposed to trading it and taking those gains and losses in the accounting. It's going to be a nightmare for it now, especially that the IRS is taking a very deep look at it. So, I mean, that's my way of thinking about it. But, the big boys, right, like, they don't do it necessarily. They hand it off to their fund admins and their account. So, you got to figure out how you want to manage that.
Hire an accountant, right?
Exactly. No, I mean, I'm definitely not an accountant. There are a few things I'll say, though. I mean, obviously, hodling is like the easiest way to manage capital gains, just not having them. If you acquire, I mean, we're seeing the mainstream avenues to acquire Bitcoin just continue to increase. So, like, we just invested in Fold app, where they're launching a Bitcoin rewards debit card. And if you're getting Bitcoin by spending money just as you normally would, then hopefully that's Bitcoin that you can just like keep like in in Fold or move it to a hardware wallet, wherever you want to keep it, and just like not think about it, because it was really like it's the equivalent of the airline points or the hotel points that you would have gotten. It's kind of found money, and you can just let it appreciate without having to deal with the tax consequences of trading it. Beyond that, I mean, there's some interesting dynamics around because Bitcoin is a commodity. If you're trading in, I think it's certain types of futures, you can get 60/40 tax treatment. So that's something to kind of look into or have your accountant look into. But really, like the cleanest way, if you want to actually like own the Bitcoin rather than trading futures, cleanest way is just to be a hodler.
Great. Well, thanks for all those answers and the really great discussion. Were there any questions from the audience that you remember particularly that stuck out in your mind? Do you remember any questions from the audience?
Yeah, I mean, actually looking at the chat questions, like I thought the questions around like, well, hold on a sec, do we want like central bank digital currencies that are like just run by governments, being the end all be all of crypto? I think is like a very important question. And I think like the answer is like, we want a diverse ecosystem. We want the sovereign components, because that takes a lot of friction out of the economy. It makes it easier for small businesses to grow without the burden of high interchange costs. They keep more of the revenue that comes in from their businesses. So I think like there are benefits to having a vibrant central bank digital currency dynamic, but then I think there are also really big benefits to having the open side, and we probably see it the most innovation, or at least a really healthy amount of innovation on the open source side, even 10 years down the road with both. So I think that's an important question. It's an important thing for us to continue to talk about. So I thought that was great.
Yeah, I think that question was actually asked by Jonah Curry, and he or she said, do you actually want a controlled digital crypto run by the government, Federal Reserve? David, do you have any parting thoughts about that?
On the Federal Reserve side?
Do we want a controlled digital crypto? Yeah.
I'm not against it at all, because I think that actually democracies in a way are kind of like the original crypto, the analog crypto, right? Like, we select the people who kind of, at least in the US, right, indirectly, right? It's like a delegated proof of stake system, non-digitized, right? And then it just flows through a little differently, right? So I just think crypto is a tool that, generally speaking, enables another form of global, decentralized, digitalized governance. And I think we have that in the US with the way we structure our society. And, can we kind of make that more efficient by using a digital currency. I think that that's exciting within the context of our society. I don't think that the government, our current structure is going to go away. I think the crypto enables us a new one to have in a different way in a cyber realm. And I think that you certainly can see both. And I think that it certainly benefits to efficiencies in the way we're going to conduct our society from a fintech perspective. I don't think it's much different from a governance perspective, right? You're not tying together global economies in a neutral platform, but I think it's great to have a central bank digital currency, and I'm excited to see what happens. One thing that I'm interested to see, that I'm thinking about, would be, how does the velocity of money change in the traditional sense within the traditional fiat monetary system once that's introduced, and you think about the way that settlement happens and the way that correspondent banking works, and you think about the way that you have to have working capital tied up within other banks globally to facilitate, trustful meetings of exchange. And it's complex how they do it, but I'm interested to see what that means. That's one interesting thing for the traditional legacy side of our financial system, right? That'll be interesting to see how it plays out. So.
Great. Thanks for those answers. So that seals it then. Jonah Curry, you won this episode's contest. So please claim your reward by going to the About section of Cointelegraph's YouTube page and contact the email address there, and we will send you your code. Thank you guys so much for coming on the show today. For those of you watching, this has been Seth Gins, who is the head of liquid investments and managing partner at CoinFund. And we also had David Greider, who is a digital strategist at Fundstrat. If you guys enjoyed the show, please hit that like button and subscribe to our channel so you can stay tuned. We have the show every week on Thursday afternoons, so you'll be updated and kept in touch for the next one. I'm your host, Jackson. I'm a journalist at Cointelegraph, and thanks again. See you guys next time.